Hi, Jodi Porteous here. I'm an accountant of 20 plus years who is here to help you understand why you can run your financial reports and why you need to run them and read them regularly to have accurate reporting. So, one of the things that a skilled business owner will have is that ability to not just make decisions based on their gut, but make decisions based on their numbers. So, the numbers of money in their bank account, which is why I also teach profit first, but their numbers on their reports as well. So once you can read and understand your reports, then that gives you a better understanding of how your business runs, and you can check if your data entry is being done correctly, whether that's by yourself or by somebody else. And what understanding the reports will do is give you that understanding of that overview of the business without getting stuck into the nitty-gritty. So I've got the balance sheet and the profit and loss here from demo company in Xero. So if you do have Xero, you're able to access the demo company at any stage. Now, the biggest thing with the balance sheet is it's a snapshot in time. So it's only at one particular point in time where these numbers are true. The next day or the day before, the numbers may have changed because there's always changes happening in your business. So this particular example of the balance sheet is of the 31st of March 2022. So we can only go backwards in time with the balance sheet. We can't go forwards and know those numbers. We can project it, but we can't know those numbers. So a balance sheet is always a backwards in time look at what position your business was in at a particular date. They also call this report the financial report of position of where you're at. Okay, so the balance sheet shows your assets, which are the things that you own, your liabilities, which are the things that you owe to other people, and then your equity. So, briefly, your assets are the things that you have control of. So, we've got examples here your savings account, your accounts receivable, so the money coming in that you of the invoices that you've sent out, and your fixed assets. So, some examples of fixed assets are office equipment, plant equipment, motor vehicles, anything you're using that's long term. It will generally have a resale date and can cost anywhere more than $300 or $500 will be an asset. On the flip side, yes, your stapler might last for 10 years, but if it only costs you $20 for a stapler, it's probably not an asset, it's more of a consumable item. Okay, so your assets are the things that you own, the things that you have control of, and the things that you may have a resale date on or be able to easily convert to cash. Your liabilities are the things that you owe to other people. So our accounts payable are our bills that we owe to other people. This business bank account here shows it as a liability, which means we owe money for that. It's in overdraft. So it's not cash in the bank of $13,000. It's cash that we owe the bank of $13,000. GST, if you're registered for GST with the tax office, that's something you owe, so it shows as a liability. Same with pay-as-you-go withholdings tax and any expense claims that you owe to your staff or yourself for things that they've bought. Now, two on here on the liabilities, this historical adjustment and the rounding, those are things that you may need to look for and look at and ask more questions if they show up on your reports. Generally, the historical adjustment will be an opening balance error where your initial bank statement or your initial fixed assets when you started using Xero haven't been bought into the program properly. So historical adjustment generally means there's something going on with the before Xero numbers. Okay, so we've got your assets which you own and your liabilities which you owe out to other people, and then we've got your equity. So your equity, generally speaking, is the maths you have to do. So assets minus liabilities equals equity. And that's the first way that I explain it. So when we take all of your assets, if we pay off all of your liabilities, what's left over is your equity. You can also describe your equity as how the business has performed over the life of the business. So every single time you run a whole year or a financial year, the profit then zeroes out at the end of the year and goes into this retained earnings or current year earnings figure. So equity is made up of all of the profits and all of the losses that your business has made over the life of itself. So the last thing that I want to show you or tell you in the balance sheet is that some of these numbers are correct, and they will be correct every single time. So things like your bank account. Your bank account balance on the 31st of March, if everything's in and reconciled, then this is your bank statement balance. If it's not matching what your bank statement says, then you need to go back and figure out why. Is it something that hasn't been entered? Is it something that's been entered twice? Or has something been coded to the wrong bank account and so it's throwing both bank account balances out? So making sure that your bank is matching your bank statement is really important, and especially in Xero where we rely on bank feeds so much. If something's gone askew or gone awry and for some reason bank feeds doubled up or gone missing for a day, then we can easily, from this process of checking, make sure that that's correct. With the accounts receivable, those are the things that people owe you. So the invoices you've sent out that haven't been paid yet. So there's more reports you can run in Xero or in your accounting software if you're not using Xero to figure out what this number is made up of. And then you can go and chase those people, send them a friendly reminder or an email or ring them up and say, hey, it's my money. When are you going to pay me? And you're allowed to do that because you've sent them an invoice. With these fixed assets, those are the things that you own. Generally long term, so it might be a computer, a piece of equipment that you're using to generate income in your business. What I tend to find on the balance sheet for most small businesses is that your balance of your fixed assets is zero. So it's got a nil balance. And the reason for that is because we, as accountants and doing your tax at the end of the year, will put through what we call depreciation. So depreciation you will see on your profit and loss, which is the claim for whatever it is that you've bought in that particular tax year. So at the moment in 2022, we're talking the tax rules with depreciation is if you buy anything, you can claim it in the same year as your profit and loss that you bought it in. So if you did buy a new desk and it cost $800, then that $800 will then flip over, so it'll be sitting on your asset list. And then we'll claim the whole $800 on your depreciation over in your profit and loss, and it'll be fully claimed. So the balance we see in your assets after we've done depreciation is zero, even though you might be able to sell that desk at a price later on. So be careful of the values that are showing in your assets. It may not show a correct value of what you might be able to get if you were to sell that thing. Same with motor vehicles, same with equipment, same with everything. So just be aware that the numbers on this fixed asset side of things may not reflect what you'll be able to sell it for. Now with your liabilities, you should be able to prove all of those figures. Your accounts payable are the bills, so you can run a payables report to show you what bills are still outstanding. Your GST should be what you haven't paid to the tax office yet. And there's timing issues there, which I won't go into. But if you're on a cash basis of GST, just always make sure that this GST amount's going up throughout the quarter. And then once you've made that payment, the GST amount goes back down again. So it'll fluctuate depending on whether you're collecting the GST or paying it out to the tax office. So all of these numbers on your balance sheet can be proved in one way or another. Pay-as-you-go withholdings is your wages tax. So this is the amount you still need to pay to the tax office. So with your balance sheet, you want to have a good understanding of what you own and what you owe. And if all what you believe is true matches with this report, then you can rely on the balance sheet and you can rely on the other reports within your system as well. Now, on to the profit and loss. So the profit and loss is a snapshot of a period of time rather than one day. Now, this particular profit and loss is for the 9 months ended the 31st of March. So from July to March. It starts off up the top with income, so sales in whichever form that is. Then we'd have our cost of sales. So that isn't in this example, but I'm going to stick it in for you now. So we go insert, not there. So we'd have a cost of sales in here, cost of goods sold, and that would be a minus figure here. So it would be minus. So if it was $10,000, then your gross profit would be $13,000. So you can then work out over a period of time whether your business is going to make you a gross profit of an amount that will then cover your other expenses within your business. So cost of goods sold will be stock or materials that you use to produce things that you then sell. And then your operating expenses are the things that you are then spending on a regular basis for your business. So things like advertising, cleaning, entertainment, motor vehicle expenses, stationery, wages and salaries. Now, there are some things that you might need to look at when you are running this profit and loss. So things like comparing it to this year versus last year. So what are the trends that are happening? Is it something out of the ordinary? And you may need to be able to go back into your accounting software and review the transactions that make up the totals. So your profit and loss is the totals report of what's been coded to all these things. And then what you need to look at is, are those totals reasonable? Is it what you believe is true? If it is, then you can work through and understand what else you need to change in your business if that's what needs to change. Now, the number that most people look at straight away is this very bottom one, which is your net profit. Now, in this situation, our profit has brackets around it, which means it's a minus number, which means it's a loss and not a profit. So we're looking for a positive number here, not a negative number. So where our sales are less than our expenses, and I've just added another $10,000 worth of costs in there as well. So actually it's less than that again. So that net profit, when I've just chucked that extra $10,000 in, is now a net profit of minus 22,000, so a loss of 22,000. Now, be mindful, your profit and loss doesn't necessarily ring true in your bank account. So there's things that happened back in your balance sheet that don't show up on your profit and loss statement. So be mindful that just because you show a profit doesn't mean you have cash. Just because you show a loss doesn't mean you've got no money. Sometimes they do correlate. In fact, quite often they do, but sometimes they don't. Okay, so those two reports, your balance sheet and your profit and loss statement, are the two reports that are recommended that you look at on a regular basis to see whether what you believe is true in your business is actually true in your business, so that you can then see what those trends are and make better decisions about your business. If you've got any questions, please reach out.